if we allow banks to go back and act the way they did before the global financial crisis,
Okay,
which I
you see
know
me getting uneasy in
gets
my
you
seat here.
upset, right? Well, eventually something happens when we deregulate,
There is
right?
a bank in
There is
Silicon Valley
eventually,
that would like to have
yes.
a word with you.
I mean, we either blow the system up because there's too much debt, or we have to somehow come to a solution about how we refinance it.
You're speaking with a millennial advisor here. If we can get the financial response that's just kick the can down the road and deal with it later, I have been living that for the better part of 30 years now.
This time it's not different.
This time it's not. Morning. It is Tuesday, April 15th. This is Ryan Archambault of Gold Seal Financial Group with Wellington Altus Private Wealth, and I'm joined this morning by our Chief Market Strategist, Dr. James Thorne. Dr. Thorne, thanks so much for stepping in to be here with us this morning.
Thanks for having me, Ryan. Nice to see you again.
Nice to see you again as well. Wanted to follow up on our chat from last week because, I mean, the U.S. market just had its deepest bond sell-off since 2001. That drove the largest spike in treasury yields we'd seen since the 80s. And while these debt markets have served, historically as kind of an indicator of what's going on underneath the hood of the financial markets, I do recognize it's not the most exciting topic for a Tuesday morning. So some of our, more stock, more headline investors might be more interested in, why does this movement in the U.S. debt market impact the equity markets? I mean, if you're a stock investor, what's going on here? What do I need to be aware of?
Well, first off, all the information is I would suggest to you is in the fixed income market. One, two, I think we need to be open-minded and come to the understanding that this credit market or this bond market is not our parents' bond market in the sense that it is really driven by short-term trading by hedge funds. And so what I would suggest to you, what that, that move up and that spike up in rates, even though it was very dramatic, and it was still below the 5% high in the 10-year that we saw in the cycle. What it does tell you is how much leverage, short-term leverage, is in the bond market and how much volatility now exists because we've got these hedge funds in there leveraging 20 to 1. And if the trade goes their wrong way, their compliance department's coming in and saying de-risk, de-risk, de-risk. So we've got these moves that may not be as emblematic of fundamental changes in the economy, but are more emblematic of people making bets. And that's okay. That's okay.
Yeah, and
but
a shakeout of that is totally fine. I mean, that's some froth that perhaps just needs to be corrected. What worries me is, I guess, the more systematic side of this, that, this is a response to tariffs at the end of the day. And the worry becomes, there's a lot of foreign holders of U.S. debt. And you've got a nation here with the U.S. that says loud and clear, you're going to have to rethink your trade relationship with me over the next decade. I mean, we saw a lot of dumping of these bonds coming from Japan, coming from China. And I guess the question becomes very simply, if you can't trade with the U.S., why do you need to hang on to U.S. debt and U.S. dollars?
Well, first, it's because, the way I look at it is, let's go back to the previous administration when President Biden and Janet Yellen basically went and attacked the Russian bond holdings of U.S. Treasuries. So I think it was about $600 billion of U.S. Treasuries, wow. And they commandeered the interest payments. Well, here's the point, rightly or wrongly, okay? Rightly, like, I don't want to get into it, but here's the point. If you're sitting there in a country around the world and you were using U.S. Treasuries as a safe haven, and you thought it was a binding contract, well, guess what? The United States at any point in time, at the flip of a switch, can come in there and say, we're not going to pay you. So that was really bad for their franchise, right? Because, Ryan, what they need to do is they got to make sure, you kind of touched on it, that people are willing to buy their product. And their product is treasuries because they need to finance their economy. However, I think the crux of the matter is until China freely floats their currency, the renminbi, and until China freely floats or freely opens their capital account, which means allowing capital to come freely in and out, the United States dollar is going to be the medium of exchange, and the U.S. debt market is going to be the debt market
Well,
of the
that's the
world.
one. I mean, that's the assumption under fire right now, right? And this is where the foreign dumping begins to scare me a little bit, because you have to understand I am a millennial advisor here, and I grew up in a world where when there was trouble, when there was recession, when there was turmoil, the U.S. issued debt to get out of it. There was always a healthy appetite for that, and I started out in the depths of the financial crisis. So my timeline, my lived experience is that. The governments will step in, they'll issue debt. If the market will not buy that, the central banks will, and they'll inject a whack of cash into the economy through that process. Markets then have a heyday, and then we get stuck dealing with this same cycle all over again with a higher debt load the next time we run into trouble. Are you seeing that era is coming to an end? Is
It is,
Jerome
because
Powell
think
not
about
coming
it.
for me?
Yeah, because Ryan, what we've been talking about is this is like World War II or World War One, where the governments have issued a massive amounts of debt, and now we need to go through that handoff from an economy that's been based on government spending to an economy that's based on the private sector, or what Scott Bessent, the Treasury Secretary, says, the reprivatization of the economy, right? So what you've got is you've got debt levels at 125% of GDP in the United States, deficits between 6 to 7%. They can no longer kick the can down the road. So, but they still have to refinance the debt. And the question is, how do you do that? And then the thing I'd go back and say to you, I hear you about people who are upset about the the um, the US, but here's the point. What are you going to do? Where are the deep markets? So sure, there might be a little bit of movement away. Maybe that's why gold is we love gold so
I would
much, and
say
we think
so.
gold's
Yep.
going to be 5,000 by the end of 2028. Maybe they're buying Bitcoin, but these alternative forms of store of value. But the key comes down back to is that debt has to be refinanced. And the way we're going to do it this time, which is okay, interest rates are going to have to come down. But the number one thing that I get really bullish about is the US dollar is starting to come down, Ryan. And the US dollar is the key to the what they call the global dollar cycle, but it also allows folks outside of the United States to refinance their debt at better terms, because their currencies are becoming appreciating against the US dollars. And the key relationship with that is the Japanese yen, because a lot of the emerging market and China do their financing in the euro dollar market, and they go through Tokyo. So if the Tokyo yen, or sorry, if the Japanese yen gets stronger, that
Yep.
means the financial position of the Japanese banks are better, and that means they're willing to lend more, and we get our way out of it. So the thing that you've sort of touched down, but is so profound, is we're going to refinance this debt in all these different ways, and it's just not going to be the brute force of the central banks of Canada and the United States or Europe expanding their balance sheet. That era is over.
Well, I get worried when I can't just kick the can down the road, because that's all I've ever known at this point. But what you touched on last week, and I mean, if part of it is just the currencies and the hedge funds stepping in to shake out a little bit of froth, you and I we've done shakeouts. I worry about the longer term, the more systematic here. But what you touched on was the notion that even absent of foreign demand for the US's debt and their ability to issue, there might be some homegrown solutions. Now, you kind of touched on that in the form of regulation on the banking side, and I'd like you to tell me a little bit more about what that looks like.
If we allow banks to go back and act the way they did before the global financial crisis,
Okay,
which I
you see
know
me getting uneasy in
gets
my
you
seat here.
upset, right? But they become a big buyer of US Treasuries, and they provide liquidity. So I would suggest to you, what's happening is there is this movement afoot in the United States to basically change the regulation in terms of the supplemental leverage ratio that banks have, which basically is fancy talk for if banks go and buy bonds on their own account. So these are principal trades, not agency trades. They do not have to basically take those bonds and mark them against their capital. So they can take all this money that is sitting idle at the Fed, and they can put it to work in the bond market, and they can become big purchasers of US Treasuries. Hence, problem solved.
You can see the worry in my face and know exactly where I'm going to go with this. But the last time that we deregulated the banks and loaded them up with assets that we told them were risk-free, it was subprime defaulting mortgages, and we had a really bad time. The world didn't like our industry very much after that. Why is it different this time?
It's not. It's
It's not.
not. I mean, we're going to deregulate and something's going to break. But you've got to do something with that so much. There's got to be a solution, and desperate times calls for desperate measures. As a job as a strategist, I'm just telling you what, if we're looking at a solution, what else do we do? Do we do a debt jubilee? Do we just write off all the debt? Do we blow the system up? Is society ready for the Central Bank of Canada and the Fed to expand their balance sheets to infinity and beyond? No, but what we do know, Ryan, is that we've got a ton of debt, a wall of debt, $10 trillion of debt that has to be refinanced this year. This year.
This year.
And it was financed at zero rates. And if you finance it at 4%, then the interest payment on government debt goes through the roof and it's unsustainable. So there is a solution that needs to happen. I would suggest to you that what happened last week was this trade trying to front run the regulation, right? Got crowded and over levered. And what we saw was the predominant move in the yields were those hedge funds taking leverage off. And what they call the movement within the swaps market was what drove this. And it seems reasonable. I just don't see, we're looking at the tick data, that there was significant amount of selling from the Japanese and the Chinese. In fact, there's a little bit of buying that really drove that knee-jerk reaction last week that we
And if
expected.
it was just a hedge fundy shakeout, that I can deal with. Again, we're focused on more of the longer term, but if that type of bank deregulation is something that we see only having consequences, 10 years down the line, there is a bank in Silicon Valley that would like to have a chat with you, I think. But last one,
Sure.
really quick before we move on. There's a replacement coming down the pipeline. Fed Chair Jerome Powell is coming to the end of his term. White House is starting their talks and conversations on who could be a potential successor. Who do you think Bissent has his eyes on for a tap for that to take the realm or take the reins?
So I think President Trump, I think what the move afoot is what we're going to move from a policy that was anchored off of Keynes, J.M. Keynes, which would be the central banker would come from MIT, Princeton,
Those
that
guys.
ilk, right, which is Keynesian, and go more towards a University of Chicago, Milton Friedman, Alan Greenspan, market-based type Fed. So I think that's the big wave we're starting to see. Right now, I think the more profound question is, even if you put somebody in there, central banks in Canada, Europe, and the United States are the last bastion of a progressive left policy. And it will take more than just putting in one individual to change the way that these central bankers look at the world.
Right.
So if that is the case, then you really are thinking about somebody with a very strong personality who is going to be able to deal with all these individuals that agree with the view that, deficits don't matter.
No,
right? Modern monetary theory. So
exactly
I don't know who it would be, but I think with Scott Bessent's selection as a Secretary of the Treasury by President Trump, I think he has a good list, and it's going to be very interesting to see how this all plays out.
Yeah, it's unfortunate. I actually did think that the Honorable Fed Chair Joe Rogan did have a very nice ring to it. But I agree. You know what? The pendulum's swinging back the other direction. It's not just government. I think we're going to see that reflected in the central banks as well. But that's as far as we're going to push the topic this morning. Dr. Thorne, I want to thank you so much for taking the time to lay this all out for us this morning. We really look forward to keeping up with your insights as all of this unfolds. So thanks so much.
Love chatting with you, Ryan.
Till next time.